The Director-General of the Debt Management Office, Patience Oniha, has announced that Nigeria successfully raised 7.043 trillion naira in domestic debt for 2023, exceeding its targets and highlighting strong investor confidence in the Nigerian economy. Oniha attributed this success to several factors, including the depth and increasing liquidity of the domestic market, particularly among institutional investors such as banks, asset managers, pension funds, and insurance companies. Now, this successful domestic borrowing comes amidst a significant increase in Nigeria's overall public debt, which reached 87.38 trillion naira by the end of the second quarter of 2023. At this point, Oladipo Ajayi, head fixed income and FX, Chapel Hill Denham Securities, joins me to talk more about this. It's nice to have you around on the show.
Thank you very much, Leko, for having me on this morning.
Now, according to the DMODG, Nigeria exceeded targets and successfully raised 7.043 trillion naira in domestic debt for 2023, highlighting strong investor confidence in Nigeria's economy. Did you actually see that coming, looking at what transpired from the beginning of the year till now?
Well, if you look at market generally, in a market where the biggest asset managers' portfolio has been growing aggressively, and that is the pension fund assets. Majorly, their investments are close to 80% into risk-free assets, and which the government security actually ranked as number one on it. And so when you look at that and you compare how much the government is willing to raise in the market, of course, it's not impossible for you to think that the government would have been able to actually raise such fund. And also, when you look at the trajectory of the borrowing from the beginning of the year, and you look at the level of oversubscription that we've been seeing month on month till the month of December, of course, it's actually crystal clear that you will know that we'll likely be able to actually hit the mark of that 7 trillion.
Well, it's quite interesting, Oladipo, because irrespective of the credit ratings, which has now been revised to positive, and on the macroeconomic indicators in the country, we still saw that institutional investors defied all these to go for the federal government's debt offering. So is this about the interest rates, or are there other factors that contributed to this?
Of course, if you look at what we saw in the market, imagine at the beginning of the year, let's take, for example, the longest tenor instrument in the market was trading about 13% levels. But as at the close of the year, that was the last auction of the year. The same instrument was issued at 17.30. Of course, that looks very attractive to any portfolio manager or any investor that is willing or looking at investing in a market. And also, if you look at the treasury bill space as well, we opened the treasury bill instrument at a single digit at the beginning of the year. And just at the close of the year, we're already very close to around effective yield of around 15%. But those also forget that at the time, towards the end of the year, the effective return actually went as high as 20%. So in such an environment as ours, having a 20% investment, annual investment, is not a bad one. And I guess that's one of the reasons why we saw interest from most investors into that segment. And also, another advantage for the government securities is that when you invest as an individual or as an institution into maybe a private issuances, you are actually going to pay 10% withholding tax. And that's also more like a deterrent to most people. So a lot of people would rather want to invest in government security and be able to actually avoid such tax.
Well, I recall at some point in our previous conversations, you expressed fears that with the rate at which the federal government was raising money in the debt market, it could crowd out the private sector. Did that happen?
Yeah, and I've not changed my fear. My fear is still there. And also my fear has also been extended into next year now. Because in the same vein, the government has proposed to actually raise 7 trillion also in the local market next year. And it means that it has further strengthened my fear. If you look at it critically, except the big names like Dangote and MTN, I doubt there's any big name, any big institution that was in the market this year to actually issue instruments. When the government is already issuing instruments at 17%, Of course, it gives you an idea of where a corporate will come to raise money. It means that of course, the investor will be asking for maybe not of 20% or very close to 20% from private issuances. So I think this will actually affect most private organizations, and they might not be able to actually compete with the government in the market. And that what will mean to most of them is that it will mean higher cost of finance to them. And I don't think this, to some extent, is positive to them.
Okay. Now, the DMO boss has always talked about the debt and the increasing liquidity in the domestic market. So I'd like you to talk to us about this and factors that would be needed if we hope to sustain or deepen this liquidity, as of course it helps the market grow.
Yeah, sincerely speaking, our market has grown aggressively because when you look back to like about 7, 8 years ago, on average, what we normally issue monthly is just about 60 billion, maybe across 3 maturity or across 2 maturities. So it tells you 60 billion times 12 is just about 720 billion. That's more like the average what we normally issue in the local market in the last maybe 5, 7 years ago. But as we speak now, the same amount is what we raise in the market just in one month. And it's not only the fact that you can actually raise that in the market in 1 month. It also the fact that the market will be oversubscribed. If you look at what happened at the last NTB auction, the DMO actually only floated just about 11 billion on the 365-day bill. We saw subscription of about 1.65 trillion. It tells you the level of available fund looking for investment destinations. And a lot of people in a market where there's a lot of volatility, or in a situation where there's no the global economy is more like turbulent, a lot of people want to stay in more like a safe investment where to some extent you can actually preserve your funds. And that's exactly why a lot of people are looking to just continue to stay in government security and not want to take risk in such a time like this. So if you look at Nigerian market, I think Nigerian market has actually grown over time. And another good thing is the fact that with the 7 trillion that we mentioned, this is excluding the fact that foreign investors are not in our market. Imagine that the doors are fully open now, or imagine that foreign investors now have that confidence to actually pushing their FX into our market and come into our market. It gives you an idea of how much more the government would have been able to raise, or how much more our bond market would have actually grown. And I feel that it's a very good one to the government. And I think the SEC and the FMDQ have done a great one around that by further deepening the market so that people can actually come and trade in it.
Let's not tie that to this. Most times when the DMO chief talks about debt sustainability, she usually references debt to GDP ratio. She has also talked about the spread of maturity and the dynamism of some of the terms. Many have actually faulted these metrics. But then what are your thoughts as regards this, most especially looking at the 2024 budget proposal and the expected deficits?
Well, my thought remains the fact that, you see, just like what you mentioned, debt to GDP ratio is one of the metrics, but it's not a potent metric. Because when you look at like a country like Nigeria, where our debt to GDP ratio is still one of the best in the world, but yet our cost of servicing debt to the revenue generated, it cannot be compared to that. When you are servicing debt with close to about 95% of your revenue, of course, it actually make nonsense your debt to GDP ratio metric. So for me, I think we should be looking more at cost of servicing debt to the revenue. And this was highly capitalized in this current budget, the budget for 2024, where the president actually mentioned that they are looking at growing the revenue generation capacity of the country. And as a result, cost of servicing debt to revenue will now be around 45%. And for me, that makes a lot of sense. It means that we are now half of what we used to be. So if we can actually work with what we have actually put on the table, if government is able to generate as much revenue as he has proposed in the budget, and if government is able to actually stay in line with what they have actually mentioned to actually raise as debt in the market, of course, it simply means that our cost of servicing debt to revenue would have dropped significantly to 45% level, and that would be a very good one for the market. So when you look at the total borrowing, overall total borrowing, I don't think we have gone too much overboard. And my concern is not even more about borrowing. My concern is what you are using the fund to actually do. If you use fund borrow to actually develop the economy, improve the standard of living of people on capital infrastructures, of course, you expect that. Of course, I will support that 100% because I know in the long run, the benefit will accrue to government. It will improve the revenue generating capacity of the government. And a lot of things will come to the government table that will be more like the dividends of such decisions. But when you actually now borrow for consumption, that is where I have my own reservation around. The government can continue to borrow to actually develop the country, but they should also not take their eyes off the fact that they must ensure that the capacity to return or service the coupons and the interest is there, because that's one of the great things that most investors actually consider. And just like what you mentioned, when you look at the way we actually staggered the maturity of our debt, to some extent, I think DMO did a very great job around that. Most especially their foreign loans. They've been able to stagger in a way that they are always like a 1 year timeline between one maturity and the other one. So it means that it gives government the ample opportunity to actually be able to actually make preparation to actually pay such loans. So for me, information, I think the 2024 budget is not totally off, but I also just feel that we must work to ensure that the revenue projection on that budget is actually actualized.
You've talked about Nigeria's debt in that line, but then this successful domestic borrowing comes amidst a significant increase in Nigeria's overall public debt. Of course, we know that it's around 87.38 trillion naira, and that was that particular figure came at the second quarter of 2023. But then when we look at this, while domestic loans account for 54.13 trillion naira of the total, and you look at the mix, is there any positivity in this index?
Yeah, I think when you look at the mix, I think we are safe. What I mean we are safe is the fact that we have more local borrowing than foreign borrowing. Foreign borrowing is more of the concern to me because when you look at how the currency has been very volatile, it means that it could further worsen. Okay, let me just do a quick breakdown of the 87 trillion that we are currently having. We know currently that about 54.13 trillion is as a result of local borrowing. And don't forget that just like what you mentioned, that second quarter, we added the ways and means of 22.7 trillion. It means that assuming the ways and means is not there, in our local borrowing would have been about 32 trillion and not the 54 trillion that we're currently sitting on. And when you look at the foreign borrowing too, foreign borrowing is about 3.25 trillion. But don't forget that what actually was in the foreign borrowing, close to about 60% was as a result of the valuation of Naira. So it simply means that if we have been looking at this figure before the devaluation of Naira, maybe our foreign borrowing would have been about 20 trillion thereabouts. And that's one of the reasons why I feel that borrowing offshore has a great disadvantage to us, because it means that if our currency continue to operate the way it's operating, it will even without taking additional loan, it will further worsen our borrowing status. And for me, I think all in all, we have not done badly, like I actually mentioned earlier on. 87 trillion is not so much out of place for a country like Nigeria. But the main thing is that are we really generating enough revenue to actually service this obligation? That is my concern. What's the government doing to ensure that they improve the revenue generating capacity? That's also a concern to me. And I feel if we tick all those boxes, talking about 87 trillion, it will not be anything extraordinary for a country like Nigeria. But the main thing is that we must ensure that we increase our revenue generating capacity so that we can one way or the other tone down on the aggressive aggression at which we are actually borrowing, and also at the same time have the capacity to service the already borrowed fund.
Well, yes, we know that the Nigerian government has been doing quite a lot in that regards, talking about the issue about around the tax system. And of course, the Nigerian government has also been talking to a couple of investors, trying to tell them to bring in their funds. Are there other areas that you feel that the Nigerian government may need to look into? Some people have talked about further diversifying the Nigerian economy and looking at fiscal issues, bottlenecks that need to be addressed. What's your take on that as regards what needs to be done in terms of revenue mobilization generation?
Later there's a lot of things that we need to do as a country. Firstly, we must work on the security issue in this country, and is one of the key things that's currently affecting investment into Nigeria. We are talking about diversification of the economy. We are talking about moving away from oil and also look at other sectors. And the first sector that always comes to mind is agriculture. And agriculture in a country where farmers cannot actually access their farm, in a country where a lot of harvest is actually is currently rotting on the farmland because farmers cannot actually get to actually access the farm to actually harvest. For farmers to actually actually access their farm, they need to actually pay bandits so that to be able to access their farm. So it simply means that the first key thing is that we need to actually work on the issue of insecurity. And secondly, as well, have you thought about the reason why a big company like Mobil will want to leave Nigeria and say, okay, they are divesting and selling their assets to surplus, but yet they are moving to Angola to go and buy new oil field? It tells you that there's something around that we need to look at. It simply tells you that we need to also work on our policies. We need to work on the principles that's currently on ground. And so as to be able to actually attract investors into our market, we are talking about improving revenue generating capacity of the country. But yet, for a long time, we are unable to produce the capacity of what was actually allocated to us by OPEC. For a long time, our allocation to us was about 1.8 million barrels per day, and we are doing about 1.2 million barrels per day. And it simply means that we are losing about 500,000 barrels revenue every day of the year. So what other ways do you think one can actually waste funds like than this way? So I think the government needs to look at what is happening in Niger Delta, look at the oil theft in Niger Delta, look at how to actually bring sanity to that segment of the market. And finally, also the government also need to look at the issue of taxation, and government needs to find a way to educate people of the reason why people need to pay tax. And at the same time, government needs to utilize the tax paid by people judiciously, so that people can actually have that free mind to actually want to pay tax. You don't want to pay tax in a country where you know that your tax will be used to actually transport close to 500 people to Dubai for a program that Nigeria could have been represented by just maybe by about 30 to 50 people. So a lot of people are also concerned about how we actually utilize the revenue generated. And that is more like the deterrence or reason why most people don't actually want to pay tax in a country like Nigeria. So government needs to find a way to actually educate people. And at the same time, government should find a way to actually judicially use the revenue generated from tax paid.
Well, of course, government expenditure focus is one other topic that we may need to dwell on in our subsequent shows, because there have been questions as regards areas where the Nigerian government expends its funds while it keeps complaining about bridging the budget gap. Well, that's another topic for another day. Oladipo Ajayi, Head Fixed Income and FX, Chapel Hill Denham Securities, thank you so much for talking to us.
You're welcome, Lekon. Thanks for having me on this morning.